US stocks rally on hopes Donald Trump will soften the blow of tariffs due next week. Flash PMI survey results for the US economy are reassuring. ANZ Research raises its 6-month forecast for gold to $3,200 US an ounce. And all eyes tonight are on Australia's federal budget, but with an election lens on. That's coming up in our 5 Things in 5 Minutes on Tuesday, March the 25th. And then in today's bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes reveals 2 vastly different approaches to supplying the raw materials for batteries after slumps in the prices of cobalt in lithium, and why miners should be wary of messing around with supply too much.
The mining industry can't really rest on their laurels because this new technology can change in the blink of an eye, and as a consequence you can be left with what you thought was a crown in your jewel but ultimately ends up not being that.
But first, in 5 and 5 with ANZ, US stock markets are rallying on hopes Donald Trump will soften the impact of tariffs when details are due next Tuesday. ANZ's head of G3 Economics, Brian Martin, says there's 2 types of tariffs to watch. Reciprocal tariffs, where the US matches its trading partner tariffs, and then tariffs on specific sectors.
So the US has identified a number of strategically important industries and has indicated that there could be quite large tariffs on those sectors. So autos, for example, could be 25%, pharmaceuticals in excess of 25%, semiconductors in excess of 25%. There's hope now that those sector-specific tariffs will not be announced alongside the reciprocal tariffs. And indeed, there's some hopes that reciprocal tariffs are introduced. They will count against potential sector-specific tariffs in the future. So the market's feeling that policy might not be as aggressive as the most extreme outcome was thought it would be. So markets are rallying as a result of that.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.3%. The Aussie dollar was flat at 62.72 US cents. The New Zealand dollar also flat, 57.14 US cents. The US 10-year bond yield was up 6 basis points at 4.31%. The S&P 500 up 1.5%. The Nasdaq up nearly 2%. Crude oil futures for West Texas up 0.9% at $68.90 a barrel. And gold up at $3,043.40 an ounce. Number 2. There was also some mildly positive news last night from the United States and Europe in the form of positive flash PMI surveys for March. Here's Brian again on those survey results with one caveat.
They were better than the February data, which was encouraging, and that also has helped to lift some of the gloom in markets, particularly in the US stock market. Reasons behind it: better weather that allowed consumers to be a bit more active, etc. So I think we've really got to wait and see what the consumer confidence numbers will be on Wednesday from the conference board.
Number 3. ANZ head of FX Research, Marja bin Zaman, says the demand backdrop for gold is strong, even with prices at record highs well over $3,000 an ounce, and starting with investor demand through exchange-traded funds, or ETFs.
Total gold ETF holdings rose to their highest level since October 2023, and investments in ETFs are normally considered strategic and meant for medium to long term. So this will likely keep gold prices supported at these levels. Also, we've also been seeing a little bit of a supply dislocation in gold, with COMEX inventories continuing to swell, hitting a record high as well. Swiss gold exports to the US also are up. Again, this is front-loading ahead of possible tariffs. So, our bullish stance on gold continues to remain unchanged. We have actually raised our 6-month forecast to 3,200 for gold.
Number 4. Singapore's annual inflation rate fell to 0.9% in February from 1.2% in January, according to data out yesterday. ANZ's head of Asia Research, Koon Goh, says core annual inflation of just 0.6% was the lowest since June 2021, and there's now space for the Monetary Authority of Singapore, the MAS, to ease.
The lower core inflation was across the board, and given the downside surprise in the first 2 months of 2025, there's a good chance that the MAS will be revising their inflation forecast lower at their coming April MPS. With core inflation tracking comfortably below its long-term average, this gives the MAS leeway to ease policy further if it sees the need to do so. We'll wait until the reciprocal tariff announcements from the US next week before firming up our call for the MAS April MPS.
Number 5. The Australian federal government releases its budget tonight. ANZ Group Chief Economist Richard Yetzinger says this one is very much in the shadow of a general election that is about to be called.
I think the budget this week actually is almost a precursor to the election, given how close it is to the election. I mean, Australia will have an election before the end of May. We're already approaching the end of March. So I think most will analyse this budget in that electoral context. And then over the ensuing month or so, we'll see what the opposition's proposing around economic policy and fiscal policies.
Richard Yetzinger there. Now, in today's bonus deep dive interview, ANZ senior commodity strategist Daniel Hynes looks at two vastly different approaches to supplying the raw materials for batteries after slumps in the prices of cobalt and lithium. The Democratic Republic of Congo, the DRC, dominates supply of cobalt, and Indonesia is the major miner of lithium.
The explosion of the EV sector over the previous 5-10 years has obviously resulted in plans to expand output across many other sort of regions. And as a consequence, prices have collapsed because that supply has overrun, I suppose, even the strong levels of demand we're seeing come through. Now, the DRC have taken steps to potentially rectify that price slump, considering it is one of their major sort of revenue earners for the country. And they've decided to essentially stop exporting the metal for 4 months at this point in time to try and arrest, I suppose, that oversupply situation. Now, it may have an impact on the shorter term. Certainly prices have rallied quite strongly, although when you take back the charts, it's still relatively low on a 2 or even 5 year sort of basis. But certainly the prospect of disruptions in that market, which is, as I said, key for the EV battery sector, has caused some concern. And this could obviously develop into a lengthier sort of ban if prices don't recover. But from our perspective, on the basis of just that short 4-month period, look, it should have some positive impacts on the prices, but ultimately the DRC is going to return to the market. And so I think the impact could be relatively short-lived.
And another metal which is connected to the EV battery market is nickel. Could you tell us what's going on there, and particularly the risks around the changing chemistry of batteries?
This sort of highlights the different takes that some countries have on commodity markets as opposed to the DRC. Indonesia, are looking to even strengthen, I suppose, their stranglehold on supply. They were virtually at the bottom of the totem pole only 5 or so years ago, but now dominate world supply, really centred around supplying nickel into that EV battery market. And they had the chance later or earlier this year to potentially rectify the oversupplied situation that market as well. We're looking at whether they should restrict quotas on mining operations there to stop that oversupply situation. But in the end, they decided to continue on with the growth or the pipeline that they have in new capacity in that country. So there is, I suppose, a risk now that that market that they'd been really eyeing as being a huge sort of revenue earner for the country could potentially be damaged beyond repair. And we're now seeing the battery industry in China in particular really pivot away from nickel with some of these nickel-free batteries such as the lithium iron phosphate ones, which BYD, the world's biggest EV battery maker, is looking to make its most part of its dominant sort of battery and really drive the really quick and efficient sort of charging times that they're talking about for a lot of their fleet at the moment. So it does, I suppose, different tacks that countries take, and it does look like Indonesia is going to continue to pour pressure on the nickel price as opposed to the DRC, which is trying to prop it up by constraining supply.
And meanwhile, those that demand the metal are trying to find other ways to not have to demand so much of it. In particular, China, finding ways to use low-grade ore and other ways to come up with a battery which can be charged fast.
It's all about cost and efficiencies. The EV sector has obviously been dogged by this impression that it takes a long time to get these cars back on the road when their batteries run flat. But they're certainly really starting to succeed in getting these batteries built very efficiently and certainly pivoting towards those chemistries that enable them to recharge quite quickly and developing and feeding the raw materials that they need to acquire that. So it's certainly a changing sort of dynamic, one which I think means that the mining industry can't really rest on their laurels.
Daniel Hynes there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, March the 25th. Catch you tomorrow with the detail from tonight's Australian budget from Adelaide Timbrell. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.